I'm Gustav Peggers from Orient Capital, and I'm introducing today's podcast. Orient Capital, also known as OC, is the investor relations division of Link Group, and we help listed companies strengthen and maintain positive engagement with their investors. In this episode, you're going to hear a conversation with Paolo Casamassima, who heads up our global market intelligence team. This discussion was an opportunity for Paolo to talk about his background and take us through some of the interesting trends taking shape in our industry. I hope you enjoy.
Okay, so let's jump on in. So, Paolo, I thought what would be helpful is maybe if you can just give a quick introduction to yourself, your background, and what you're currently working on.
Paolo Casamassima, Head of Global Market Intelligence for Orient Capital. I've been working for 15 years in investor relations. Within Orient Capital, I'm responsible for shareholder analysis, targeting, perception studies, and then business development across the Middle East.
Fantastic. So that last bit, our sort of growth into the Middle East market is really interesting. So we'll probably jump back into that in a bit. But just to start off, because we have because we have such a kind of range of listeners listening to the podcast feed, I thought it might be quite helpful if you could just give a bit of a background as to why investor relations is so important to issuers. Obviously, it's changed over the sort of last 10 to 15 years quite dramatically, but maybe if you could give a kind of high level understanding of why IR was used to listed companies and some of the benefits of it.
Well, first of all, we could start by saying that the IR function combines three aspects of a corporate: finance, communication, and marketing. Ultimately, the goal of the IR team is to make sure there is an effective communication between the publicly listed company, stakeholders broadly, and then more specifically, its investors, current and potential investors. Essentially, the IR person, which can be the IR team, or from time to time it's covered between CFO and perhaps management if there is not dedicated person, needs to create awareness and understanding about the company. And that includes trying to ensure that the broader market understands the company. So we're speaking about journalists, we're speaking about the sell side that will help bring new investors, obviously brokers that are linked to the sell side. It is supposed to ultimately help the company access capital, achieve liquidity, and attain a fair valuation of the company. The IR ability is ultimately measured based on the ability to build strong relationship with investors and analysts.
Okay, so it's interesting to me. Obviously, IR has a kind of breadth. It covers quite a lot of the business, right? So as you say, you might be dealing with COSEC sometimes, you might be dealing with brokers, you're dealing internally with CEOs or CFOs, and then you're also dealing with investors and analysts. So it's quite an interesting functionality for sort of in-house IR, because obviously you're dealing with so many different facets of the business. And obviously you're exposed to so much. So in terms of that exposure and those sort of industry trends that we're seeing, I'm just wondering what you're seeing across the markets. What's interesting right now? What's hot off the press?
So one of the biggest things that have happened since I work in investor relations, I think started to happen with the pandemic. So the work from home dynamics have really changed the way the investor relation function is run, because we see significantly less participants to events, whether conferences or non-deal roadshows. And we are told by clients that they are really struggling to get people to meet, to find the right time to meet, to organize a roadshow. So a lot of companies that used to travel, for example, from the Middle East to London or from Europe to London, they've cut budget significantly because of the difficulties in organizing those roadshows. And therefore, they will bring on board third parties to sort of organize these functions for them. Function that once was also managed by brokers, corporate brokers, and with MiFID II, this has also reduced. So a number of small cap and mid cap, they've seen the reduction of the sell side coverage, and as a result, they will have to be spending a lot more time looking for potential investors, targeting investors. Obviously, ESG, big elephant in the room. We see news on a daily, weekly, quarterly basis about things happening. And it's very difficult actually for issuers to understand, for example, which reporting frameworks to follow, what type of reporting to do, and how to communicate with the ESG investors. So there is budget being shifted towards ESG that perhaps has been taken from IR, perhaps could be from corporate roadshows, moved into ESG, but yet we see difficulties in trying to really master the knowledge of ESG. A big area for issuers, something that is relatively new and really started with the pandemic, it's the growth of webcasting. Our own division has grown in revenues to more than double, and that it's testimony of the fact that people are engaging a lot more, whether it's audio calls, video calls, recorded calls. And webcasting is just a very nice way to have a much better engagement with the investment community. So we've seen companies moving from annual webcasting perhaps to quarterly webcasting, and other companies that used to never do webcasting, they've started to do a first webcast, for example, and then it's a test, and they would want to do more depending on the success of the first webcast. We could also say the link to webcasting is the overall video content. I would say that when I started working, video content was inexistent for investor relations. We now see companies that start to upload their storytelling of their business on YouTube. Now, did you know that? I personally heard about it from a few companies while doing perception studies, but I had no idea that this was that an institutional investor may go and look at the story of a business on YouTube. Go on.
No, I was saying it's remarkable. I think you're talking about the pandemic and how, as often in these times of adversity, it really drives forward technology at quite an increased rate. Part of where we sit in IR, and especially with a lot of what you do, Paolo, in terms of the market intelligence, your story, your narrative, what you are putting out into the world and to your investors and potential investors is so key. It's so key. And having these different technology available to allow you to do that in different methods, allowing greater accessibility for investors who may not be obviously local, who may be worldwide, is just the benefit, right? This is positive for issuers. This is giving the issuers the way to communicate in more ways, more accessible methods, and getting their story across. And part of that is maintaining a bit of control of that, right? Because the flip side of this is with the message boards and with Twitter and with investors kind of nattering away online, that control can often disappear. So actually, this is a good way for issuers to take back a bit of that control and actually drive the content in a way that they think is the most productive and positive.
Absolutely agree with you. Yeah.
Fantastic. And so obviously speaking about webcasting and which is great, but also I just maybe a little bit about perception studies and about how that fits into the IR model a bit more.
Sure. So perception studies, first of all, perception studies is something that when I started my role, my career in investor relations nearly didn't exist. So it was a new concept at the time, and maybe until 3 to 4 years ago, it was still something that was done by issuers once every 4 to 5 years. Perhaps it was done around the announcement of a new strategy. Now we see it done as a 12 to 18 months, and it starts to be considered as best in class IR practice. I'm actually having a call in 45 minutes with an issuer, and we've had 3 respondents telling us, "Thank you for doing this survey. Please tell the company to do them more often. We are happy to do them in multiple formats." So we see that the perception study is not just a way for a company to try to understand what the market thinks, but it's also a way for the investor to share feedback and feedback that perhaps they would not be confident in sharing face to face with a company. In perception studies, we often cover. We touch base on the strategy of the company. We can touch base on pretty much everything, but essentially a company is trying to put a mirror in front of their actions, their performance, their communication, and trying to see whether what they see is the same as what the market sees. Is the message really well communicated? Well, we think it is, but communication may be lacking somewhere. There may be a KPI that is missing. we see ourselves as a market-leading company in this sector because of XYZ. What investors think? Is it the same that they are thinking, or do they see us differently? Are we market leader according to them or not? There are certain things that come out of perception study, and this for me is probably my favorite topic. It's capital allocation. So very often, obviously, management will spend a significant amount of time trying to decide capital deployment, dividend payout versus perhaps deleveraging, organic growth, M&A. Surprisingly, in every perception study, we are told that investors will want to see a lower dividend, up to no dividend in return for a growth strategy, an M&A strategy. And it's baffling and puzzling to many IROs to hear that. But essentially, think about it. Would you like to see a 30% growth on your share price or 5% dividend and no growth? Obviously, you would like to see the 30% growth.
Yeah, no, absolutely. I think that is really interesting, and actually hearing about, and obviously we've spoken about this at great lengths since I joined, but hearing about how investors view their return on investment doesn't always tally up with what the company view. And as you say, so that communication, understanding that is really key. We mentioned obviously, well, you mentioned obviously a lot of that functionality has been historically covered by brokers. So I suppose one question I'd like to put to you is, as we've heard from issuers in the past, is, well, I don't need to do a perception study because I already hear from my broker. They speak to our shareholders. They get the feedback and they relay that to us. How would you counter that? Because obviously, based on the conversations I've had, you're only getting a limited amount of feedback via your broker. And that's not to dismiss the valuable work that they do, but obviously when we're doing a perception study, it's often from an anonymous perspective.
Yes.
So do you think it's fair to say that we get a lot more truthful and transparent answers?
First of all, it's a lot of more truthful answers because the answers we get, we openly say they are non-attributable, which already gives a little bit more confidence in sharing feedback openly. Also, a broker will often give you the feedback coming from a roadshow, perhaps, of its clients. So those that trade through the bank's books. Now we get everyone's feedback, obviously a sample of everyone's feedback, but we could get the feedback across 4 different brokers, for example, and then give you the average of the sentiment, market sentiment about a specific topic. And so if you have a broker that perhaps it's bringing you a lot of hedge funds, will not give you the true indication of what the market will want to see from the actions of the management for the particular stock.
Yeah, no, that it's all hugely interesting. I think it's accessibility, right? You're opening communication lines that perhaps weren't originally there, and you're allowing for more transparent feedback that you can this is critical information that I think perhaps is overlooked, especially in the UK market, or certainly has been over recent times.
Absolutely.
And I suppose we mentioned earlier, so obviously you said we're doing a lot of work in the Middle East and looking to grow that market. It's a fascinating market out there at the moment. It's really bubbling away, right, and ready to explode. So I suppose really from a regional discussion, what I'd like to know actually is what differences have you faced? Obviously, you've got such experience in the UK and Europe in terms of working with those issuers. How are you finding it dealing with the emerging Middle East markets, and what's exciting about that?
Well, one of the obvious differences for me is the difference in terms of budgets and how this budget is allocated. Now, it's not just simply how bigger or smaller the budgets are, and this pretty much vary depending on the market cap rather than being Middle East or non-Middle East. But in Europe, UK, usually there is a budget allocated for annual report and PR, usually both, but at least one. And the remaining will be allocated to the other IR services, whether it's shareholder analysis, perception studies, ESG, advisory work, webcasting, maybe corporate governance roadshows, which are sort of bespoke rather than just the normal non-deal roadshow. Perhaps the use of a CRM, it's something that it's obviously part of the budget. Now in the Middle East, There are many companies that are just setting up the IR function. That's a big difference because most of the IR teams are one person as opposed to 2, 3, 4, which happens to be the case in Europe and the UK. Sometimes we see companies that are deciding where to allocate this budget, and sometimes it's even, are we going to hire a new person, or are we going to hire a PR company? Are we going to upgrade our annual report and perhaps make it integrated report, or are we going to add a sustainability report? And this budget, it's the same budget that will have to be shared with other IR activities, whether it's perception study, whether it's shareholder analysis, or you name it. One thing that is happening, however, in terms of perception studies, because issuers are so keen to understand, they're obviously trying to attract capital from the West, from the Western world. They're really keen in trying to understand how they compare against European issuers, UK issuers. And with many of the clients that have worked with us since IPO, there is this trend of doing a post-IPO perception study around 1 year after the IPO, where they exactly try to see where they stand against the market. And obviously, very often there is lots of room for improvement, but they are definitely keen in wanting to compete and be at the top when comparing to Western issuers.
That's interesting. And I suppose also, you mentioned there in that kind of IPO space, obviously when a company lists, and actually that idea of doing a perception study down the line, it shouldn't really matter if they've had a successful year or a non-successful year.
Correct.
Because their sentiment's going to change, right? As we know, the markets can change incredibly quickly, and the way investors behave is the same. It can be quite rapid in its turnaround. So actually doing it, even if you think, hey, everything's going fine, everything's going great, actually it might not be. Again, we speak about investor sentiment. You may think everything's going well, but actually when you get some really transparent responses from your investors, it may look very differently. And yeah, I think it's a really valuable asset to do. You mentioned budget, which of course is always part of the conversation and always comes up when dealing with companies. How do you? Okay, let's rephrase it. If a company you're speaking to says, I don't have the budget for this, why should they find the budget for it? Like how valuable is this? Like where is it a case of reallocating resources? Like what do you think this really brings to the table at its core, right? The core benefits of doing a perception study as a listed company. Why should companies be doing it?
Ultimately, you're looking to achieve a fair valuation and maintain a good relationship with your investors. And you can only do that if you have, well, obviously very good relations with them, but you try your best to get an understanding of what everyone is thinking. So there is I remember I worked with a company that was particularly focused in what the top 25 was doing. So they were monitoring the shareholder holdings of the top 25. They had a bonus, an incentive plan for the IR team and management to retain the top 25 holders, and there was no interest in respect to what the smaller investors were doing. That was it was a large cap company. So those that were moving the prices were not the top 25. It was those that were trading in and out.
And that's often the case, isn't it? Yeah.
Absolutely. So if you don't know what your investors are thinking, what's really driving your share price, how can you react to that? How can you essentially find the right balance in terms of perhaps return on investment? How can you understand what your competitors are doing? Because one of the things that is very interesting as well with perception studies is that you think you know everything about your business, but the perception study will also tell you what investors think you're doing against your peers. So you may think you're the market leading because of whatever, your great product. An investor will say, well, you lost leadership 3 years ago when peer company XYZ has launched this new product, has entered this new industry, and we have perhaps divested 50%, and we would look to reinvest if XYZ conditions were met. Very often, these are things that you will not hear in a face-to-face meeting. We were even told in perception studies feedback such as we would only invest if, for example, there was a management change, new CEO, or a new strategy completely different for the one that has just been announced. We were told that the ESG strategy and sustainability report that was issued by an issuer was completely wrong because, let's say, an oil and gas company was focusing very much on E. Well, you can't do anything about E, environmental, but you can do a lot about social and governance. Yet you're doing nothing about social, and your governance, well, is poor because your board is not independent. So you're failing on all three. So the company had to scrap completely the sustainability report that was done by the experts based on the feedback that came out of the perception study.
Look, I don't want to end on negative, but I think what is a real key takeaway from this is it's not always going to be positive feedback,
Absolutely.
but it can really be constructive. It can really be useful. And as you say, look, you're preaching to the converted with me, Paolo. I think they're a really underutilized piece of intelligence that companies can be doing. I think it's a fantastic way to strengthen relationships, build new ones, and open dialogue that perhaps hasn't happened before. When we talk about ESG in particular, I think boards as stewards of the company are being held more accountable. And the less transparent they are, the less investors trust that. And investors are smart people, most of the time. I think, stuff doesn't fly in the same way it would have done 5, 10, 15 years ago.
Absolutely.
So I think really, look, I think let's wrap it up. I think that's been a hugely enlightening conversation, and as I say, I think the work we can provide to support issuers with these reports is really beneficial. You're so switched on with this stuff. You can tell you've been doing it for quite a while. It's all, if you're natural at it, absolute natural.
You're too kind. You're too kind.
And that is a wrap. If you'd like to find out more about Orient Capital or contact either Paolo or myself, I'll leave some information and links in the description. If you found this conversation useful, don't forget that you can subscribe to this podcast on whatever platform you're listening to us on. That way, you won't miss an upload. Thanks again for listening. See you soon.